about money. Remember the website, adamsfinancialconcepts.com.
It is Saturday, and we're going to be talking about money. And when the introduction says that I host the program, we are in a transition phase, so it's not just Mike Adams, it's Al Souza and Christiane who also participate. And we're all focused on servicing our clients and taking care of our clients to give them the best results ever. So what's happening right now? We're seeing the worst inflation in 40 years. The worst set of inflation in 40 years. The Biden administration has made it a top priority. So I don't believe that history repeats, but it certainly rhymes. And there's lessons we can learn from history, and we're going to talk about some about that today. We're going to talk about what has happened, what is happening. That's the first question we're going to address. The second question is, what do we expect is going to happen going forward? Where are we going to be? The third question is, given that we expect inflation may be increasing, and that gives away part of the second question, what do you do to navigate against that? We've been warning against inflation now for 5 years, saying that the way the market, the secular bull market, comes to an end is not with a great recession, but very probably with inflation. So what do you do as investors to get through that? But we're going to start with the first question. What is going on? How did we get here?
How did we get here? Well, it didn't happen by accident, I can tell you that much.
Okay,
people just assume this inflation comes out of nowhere, right? That it just all of a sudden it just happens, because that's how it seems, right? And so I started looking at a little bit of history on inflation, not just the United States, because we all know about, most of us have a concept of the 70s and 80s, right, of what kind of happened. We've talked about it a lot, right?
We have, Al.
We've talked about it a lot. So I went back looking even at, like, in 1273, Kublai Khan in China, right? He wanted to fund his war operation. And how did he do it? Because he didn't have the money. So it was the first one when they started printing currency. And he started printing currency. And he started doing his invasions and do what he needed to do. Well, what happened? He created a tremendous amount of inflation, which is the first type of inflation we're talking about. Is not cost push, but demand pull. He just created so much money in the economy. It was just too much for them to handle. It went from, just to give numbers, I don't really understand what these numbers mean, but it went from 110 ding to 1.4 million ding.
That's a real ding-dong. No.
That's a humdinger, isn't it?
It is a humdinger.
And so I started looking at these because I just find it so fascinating to look at, because, as I said, where does it come from, right? And it doesn't just happen. It's the old saying, Mike, that the path to hell is paved with good intentions, right? People mean well.
It is.
Except for our next guy, we're going to talk about, as I looked at, is Zimbabwe, right? And so Mugabe was... he was a leader of Zimbabwe for many years, and kind of a nut job. He was a real nut job. So him, I think he's just the path to hell. There was no good intentions. But what he did is he wanted to repatriate this land back to the indigenous people. The problem is they had no idea how to farm the land. So food prices and everything went. And then at the same time, he wanted to spend money and take care. He had conflicts and war that he wanted to take care of, and he had people give checks to people, right? And they say, well, Al, it's not really like today. Well, think about it. Think about it. What did Biden just do today? We just announced that we're going to have massive presence in Europe, troops in Europe.
Yeah.
Okay. That I don't know about you guys, but that's not cheap.
It isn't.
And we're spending that money. So, and then a year ago was giving money, giving check. We were getting these $500 checks were showing up in my account. We're like, okay, I got a $500 check from the government. And so he did these things, and the inflation rate went from, it was estimated that it went from 79.6 billion% a month inflation.
No, not in the U.S.
No, in Zimbabwe.
Zimbabwe.
Not in the U.S. But the thing is why are we so vigilant on getting on top of these? Is because this stuff happens. It's like the idea of the frog, right? You throw the frog in the boiling water and he jumps out, but you throw him in a pot of warm water and turn the heat up. He doesn't know when he gets cooked, right?
Yeah.
And it happens very slowly and methodically, and all of a sudden we're in hyperinflation. And so it's really important. But
so talk about what's going on now here.
What's going on right now here is that we've had this, like you said, we've had this secular bull market that we've been going through, right? And then we had we had the Fed starting to tighten, and it was 2015, and they backed off from that, from pressure, from whatever pressure. I can't remember the time it was Janet Yellen. I think there was a crisis in China with the yuan, and they had to back off with their tightening at that point. Then COVID hit, and we all know what happened. They spent money, and then they just kept spending, and we ended up with this $9 trillion balance sheet. And at the same time, the fiscal policy was spending money to giving people checks, right? And so in 2020, though, something interesting I read is that the Fed changed its policy. The Fed went from a policy of looking at data and saying, what is the data telling us? The data is telling us we're heading towards inflation. Let's react and do something. Well, in 2020, Powell and company decided to say, we're not going to do that. We're only going to react to inflation when we actually see inflation. Well, by the time you see it, it's kind of too late to really get it under control. So that's where we are now, with the Fed raising rates 0.75 points last month, and then going to start to unwind the balance sheet in September and really tighten this economy down so we don't end up in hyperinflation.
Why should we have seen inflation back then? At that time, in 2020 and 2021, we were just beginning to see a little bit of inflation. There wasn't much going on. And suddenly we explode to almost 8%.
Yeah, we had the economy shut down then, right? We didn't have, people weren't working, and so something had to be done just to keep things going.
Well, and the stimulus dollars in 2020, right? There was $4.5 billion added to the federal gov balance sheet, to the central bank, right? So, I mean, before you were just paying essentially for 2008. You were dealing with that inflation from, the previous 10 years. And yes, we were starting to raise rates and address it, but, there was only what, $3 or $4 trillion on the balance sheet at that point?
Before 2008.
About 4.5.
Yeah, before 2020.
But even putting all that money into the economy, we didn't see inflation go up.
Well,
so
like Al said, it's a silent killer.
Well, that's what we talked about, Mike, right? We talked about the types of inflation, right? Demand pull, cost push. That was basically, we started to see a little bit of cost push going that because we had so much money flowing into the economy, but people weren't working in the demand. The demand was there, but we weren't really seeing it, right? And then all of a sudden we saw the bottleneck starting to happen with the supply chain. Right?
Now we're beginning to make sense.
Yes. Now I want to throw something at you guys, because gas prices in 2020 were $2.17 a gallon average. Today they're $4.88. That's a 125% increase. Before the war in Ukraine, things started to exacerbate. What countries started to do, countries started to try to keep surpluses of commodities. One in particular was wheat. Wheat prices skyrocketed. And wheat prices continue to skyrocket because countries said, hey, we're going to hold our own surplus. And when the Ukraine war happened almost a year later, which they produce a third of the world's wheat, we saw countries really start to that. So now all of a sudden we have not only the demand pull inflation, but now we're seeing cost push and demand pull at the same time, right? This is where the intersection of where we get the stagflation of, like you saw in the 70s. And so this is where we're at right now.
So let's just define for the listeners what the difference is between demand pull and cost push, because there's a real difference between the two.
There is, and the difference is that demand pull is basically I can't remember what the editor of The Economist said. He's
too much
money chasing too few goods, right? That's what we had, right? COVID, we had tons of money going out. The demand was there for people for buying things, and and the bottleneck came in, and then all of a sudden they couldn't get what they wanted, and the demand was still there. Cost push is more just the cost of the raw materials going up in price because of what I just mentioned. Countries saying, hey, instead of selling that wheat to my neighbor next door, I'm going to hold my supply because I don't really know what's going to happen. That's just fear, right? That's just cost push can be just totally on fear and short supply.
And you have labor rates going up, and you have commodity prices going up. That's the cost push side of the whole question. And we have both of those going on right now.
And so we still have that going on, and we still have things like even housing. Housing's still in high demand. We're seeing housing prices still go up. Rents are starting to go up. And also, interesting enough right now.
Yes, we're going to come back to that point. We've just started to delve into this. We haven't even begun to deal with where are we going in the future and how do investors profit. So we're talking about inflation. What is going on? How did it get there? We're going to talk about where are we going in the future and how do investors cope with and benefit from what's going on. All that to come. So stay with us. Al, you were talking about cost push, demand pull.
Yeah, so when we get to cost push, this is something I read from a farming magazine in 2020, talking about just wheat fall, right? And so Russia, because of droughts, that's another reason that we've had this rise in commodity prices like wheat. Russia's had a tenth of their average rainfall in the last several years, their 30-year average. And so, as I said, importers are building reserves to safeguard against global supplies. And they're seeing places like unusual demands of wheat in places like Pakistan. And China itself is set to buy the most wheat in a quarter of a century. And with their slowing economy and COVID lockdowns, another reason why we're seeing, because so much of our stuff was made over there.
And so where does that leave us right now?
Leaves us...
That could be taken a very grim way. Where does that lead us? A few months ago, I was talking about the CPI numbers and how I personally thought they were going to continue to rise. The next month, fortunately, they dropped, but this last month, back up to 8.5%. I mean, we haven't seen those numbers since the 1970s.
We did see, however, the numbers that the Fed follows. We saw inflation begin to moderate a little bit. And we're seeing the Fed raise interest rates. We're seeing the Fed deleverage their balance sheet. All those should work against inflation.
There's a lag though, Mike, right? About 9 to 18 months. So I don't think we're going to see that effects of that till probably sometime late 2023, maybe 2024.
Just in time for another presidential election.
Exactly. Exactly. And just in time.
You think it's political?
Yeah.
And then 2025, all the Trump tax cuts are going to reset back to what they were in 2016. So, we're coming to the crossroads here of what's going to happen. Nobody knows.
Well, even this week, Jerome Powell admitted he didn't know. He said, he's quoted, and this is on a panel, and I couldn't believe it. But he said, I think we now understand how little we understand about inflation. And I mean, when you hear the Fed chairman say that, and then the market rallies, I mean, it's concerning the times that we're in.
It is, though, but it's funny because when you look at the history of countries that went through inflation, I looked at, I'll go back to one of my examples, because it's just so fascinating to me, is Venezuela. With oil, right? Venezuela, Chavez comes in and says, hey, I'm going to take the country and I'm going to nationalize all the oil, and we're going to take the money and dole it out to people so we can take care of our citizens. Great idea, right? Till world oil prices collapsed.
Yeah.
And countries said, hey, I don't have to buy Venezuelan oil. I can buy it from Saudi Arabia, or I can buy it from Russia. And then what happens is they keep doubling down on it, and they feel like, okay, what do I do now? Everything's collapsing. What do? What do they do, Mike?
Ship more oil.
No, but they can't because nobody's buying it. So what does Chavez do to try to keep everything going?
I don't know.
He prints more money.
Oh, yeah.
What does that do? Right? So we end up with this. He prints more money, thinks it's going to help. It helps for a little while, of course, but then all of a sudden, wait a second. The loaf of bread costs. It's the old scene in Germany, right, with the person with the wheelbarrow, with the fiat money, taking a wheelbarrow to buy a loaf of bread.
Yeah. So where do we stand in the U.S.? I mean, you talked about demand pull. We talked about cost push. Wage rates are increasing. Unemployment rates are really low.
Yeah.
And if you look at the number of people who are quitting to move on to other jobs, it's really significant right now. And it may not slow down. Even with a recession, it may not slow down that much.
But companies are starting to lay people off.
They are.
They're starting to lay people off. I think I read the other day there's one company in Silicon Valley that is requiring all its employees to be back in the office. And so I think that, like you're saying, people are going to find new jobs if they have to be back in the office. But I think we're going to see more layoffs coming ahead here.
Well, and some of that is normal. I mean, headline was Musk is laying 10% of the workforce off at Tesla.
Yep.
But some of that is actually due to productivity gains. That happens with large companies. If you look at the largest 100 companies, they tend to reduce their labor force even as they're increasing sales.
Right.
It's the small companies, which you have to look at, that are creating jobs. A company that has 3 employees, hires one, is increasing the workforce by 33%.
Mm-hmm. Mm-hmm.
It's the small companies that are really hiring. So as yet, when you look around, you still see a lot of help wanted signs. Restaurants are having a huge problem getting people.
Mm-hmm.
But Larry Summers, he put out an article recently. He's a little bit more on the negative side. A general rule of thumb, just so everyone is aware, the Cost push inflation is 2/3 labor prices and 1/3 commodity prices. Well, right now unemployment's at 3.6%, right? Well, when it's hard to get workers, when there's very low unemployment, that means that there's going to be, people are going to demand more. So what he's saying is that we actually need to see a rise in unemployment. He says that we need to see a couple years of around 6% or 1 year of 10% unemployment to bring that back down to, start to hedge this inflation that we're seeing, because so much of it has to do with labor prices.
And that's very unlikely to happen.
Yeah.
Yeah, but we have inflation now at about 8.6%, right?
3.
Inflation.
Oh, inflation.
Eight-
I'm thinking
8.5.
of unemployment.
Let's not confuse the two.
Okay.
So, people getting raises, is someone going to get a raise an 8.6? They're going to raise an 8.62% raise? Probably not, right?
So I lived through the 1960s and 70s. And yeah, wages went up significantly during that period of time. When I graduated from college, or when I went to college, my goal for a lifetime income at a very maximum was $20,000 a year. That was huge, I heard this story recently about an intern, a college intern who's a junior in college, going to go back for another year of college, an internship at Amazon paying $75 an hour.
Wow. As an intern.
As an intern.
Wow.
$150,000 equivalent annual. And I was willing to settle for $20,000. Times are different. I mean, wages were increasing significantly. And I can remember 10% increases in wages. And that was not keeping up with the rate of inflation.
Right. And so what else has to keep up with the rate of inflation? It has to is Social Security checks. So how is that going to be affected when the government has to spend that much more money to cover the cost of living adjustments with Social Security?
And that was a difference between the 60s and 70s because we didn't have a COLA increase until late in the 70s.
Right.
So people who were on Social Security were on a fixed income. And between 1961 and 1979, the dollar lost 70% of its value. So those people that were living okay on Social Security saw the amount that they could buy drop by 70%. That's why we ended up with a COLA on Social Security. I mean, inflation picked up during that period of time. It got into the double digits.
No, part of that, wasn't that due to the decoupling of the gold standard that Nixon proposed, enacted?
Not really. I think, people look at gold and soaring.
Mm-hmm.
Gold was tied to the dollar at $32 an ounce, but gold is an inflation index. And so you had gold prices soaring far beyond the price of inflation. Gold in 72, 73 went from $32 an ounce to $800.
Mm-hmm.
Yeah.
And then it sank back to 100.
But gold prices have been
200.
consistent through all this. Have you noticed that? Gold prices have stayed in a little bit of a bubble, about 1800s and change. They haven't really gone up or gone down.
But if you go back and look at and measure gold price with CPI, go back to the 1930s when we had...
Oh, yeah.
And if you look at it in terms of inflation, even at 1800, it's still a little more than inflation has been.
You know what, one metal, though, that's been, maybe it's a little bit off topic, but as I looked at copper price. And why did I look at copper price? Because copper prices are a barometer for the economy, for growth, right? Because copper prices put in everything, computers, housing, everything. Copper prices are at a 16-month low. They peaked in about somewhere in 2021, and they've dropped precipitously ever since.
But part of that is because people get all concerned about inflation and they want to hoard, and suddenly when the hoarding is over, you've got a whole lot of inventory that you got to get rid of.
Speaking of inventories, that's what happened with Target. You want to talk about specific companies, right?
Yeah.
So I mean, I'm kind of glad because I did a remo and I want to buy a TV. They overbought on TVs and appliances, so they're sitting on gluts of appliances. So people, if you're looking for TVs or appliances, Target's your place to go. But Walmart and all of them did the same thing because we want to get to the specific companies and how this affects them. So
they order a lot. We've got inventories coming down, which is a positive for reducing inflation. But we're coming to a commercial break. Don't go away, because we've still got to talk about where are we going with inflation? What is going to be the impact for the investor? And what do you do if you have inflation? If you miss part of this program or any other program, you can find About Money on YouTube. We're talking about inventories, but if you look at it, inventories are only one part of the problem that are facing companies today. You know, there's a real issue for companies if we're going to continue to see inflation, and I think that that's what we're saying we are going to see. Think about the issues that the companies are facing.
Well, most companies that are sitting on inventory, right? And so their cost of inventory reflected on their books, right? So most companies use what's called a LIFO system. Last in, they sell. Last in is first out. That reflects what the replacement cost or what they sell, so they don't have to have a big disparity in those costs. The problem is that like Target that ordered so much and they have so much inventory, what are they going to do? That means they got to cut prices. That means profits are going to go down. That's the problem they're going to have.
And they're not alone. I mean, Nike's in the exact same boat. I mean, it just came out that they were trying to catch up with the inventory after 2020 and the supply shortages, and they're in the exact same boat. And the only way that they're going to get out is by discounting the old gear.
Right. And so the other thing is that these companies is producing cash, right? I mean, they have to right now with inflation going up, cash is going to be king, right? So
it's going to be an issue for companies and company management.
Yeah, and the growth companies, right? The growth companies, because growth companies typically don't reflect what their true pay to their employees is because they entice them with stock options. Hey, Mike, come work for us. We only got 10 employees. We're going to grow at this rate, and instead of paying you $150,000 a year, we'll pay you $100. We'll give you these options, and in 5 years, you're going to be worth X amount of dollars. That's great when the stock's going up, but what do you do now, right? Yeah. And so typically that's not reflected because they have to expense those options. That rule came out, that was a GAAP rule, general accounting principle rule that came out in 2006. Before that, they didn't have to expense the stock option. Now, the guys like Warren Buffett, who are value investors, don't like this because they think it doesn't accurately reflect the true cost of the employees. So what happens with these companies that most of them have startups and have negative earnings and where people bought their stock off the projections, they get killed in this type of economy. The stock prices tank. If they will survive, who knows?
But even beyond the growth companies, if you look at what issues are facing some of the standard companies, if prices are increasing at 8 or 9%, are they able to increase their product prices 8 or 9%?
Well, that gets back to whether they have pricing power, right? We talked about this, and that gets back to the thing of my econ professor Chong would be proud of me right now is elasticity, right? Talking about elasticity, which is basically how sensitive are the consumers to prices, right? McDonald's has their dollar meal and stuff like that. If they raise it to a $5 meal, people still going to go there? Probably not. But oil prices, gas prices, more what they call relatively inelastic demand, where people are going to buy it till it gets to a certain price. They're not going to change their behavior till it gets to a certain price.
But if you can't increase, you use the example of McDonald's, if the price of a Happy Meal, if you can't charge $5, then what else do you do to maintain cash flow, to maintain your profitability? You have to cut costs.
You have to cut costs. There's no other way to do it. You're laying off employees, you're using less, and you're moving more towards, like we've seen, you've talked about many times, is automation, right? Moving faster and faster towards automation, so I'm less reliant and I can have more fixed cost and less variable cost, right? That's my goal. Is I have the more fixed cost I have, and that it might give me a little bit more flexibility.
And carrying on with that McDonald's example, that's a direct outcome from 2020. We started to see a lot of those self-checkout. We started to see these robots that are flipping burgers. They're getting a lot more productive because they're able to get rid of their biggest expense. That's labor.
If they can do that, and can you do enough of that to keep your profit margins? What we saw in the 60s and 70s is a lot of companies couldn't. Even cutting cost way back, cutting inventories, working on receivables. The companies that really survived did all of that, but unless you had pricing power, they didn't do well. When you think about the companies that did well, they had pricing power. They were the new companies. There's a saying that one of the ways around inflation is to invest in the stock market, right? If you look at what happened in the 1960s and 70s, and I was around at that time. Actually, I started investing in the 70s. The market was at 100. The Dow was at 100 in 1941. In 1966, it had grown tenfold to 1,000. Well, actually, it never reached 1,000. It reached 999, but close enough to 1,000. And then in 1966, you started to have inflation at 4.5 or 5%. And that suddenly became a worry, and the market began to fall off until the end of 68. The market was down 20%. And then the market began to rally. And by the end of 66, by 68, close to the end of 68, the market was back to 1,000, where it had been in 66. And it began to roll down. In 66, inflation had almost doubled to 3% from 1%. But by 68, it was starting to come in at 4.5, 5%. And the market rolled down again. This time it rolled down 30% before it began to recover. And in the early 70s, it reached a bottom and started to recover and got up to 1,000 again. And inflation by 72 was again taking off, and you had OPEC, and this time the market dropped 40%. It took a few years to begin to recover. It recovered back to 1,000 for the fourth time, and then rolled down again. Rolled down 20% before it's really corrected itself. And as inflation came down under Volcker, and
that's the key right there, Mike, is Volcker finally did what had been taking so long to do. He finally came in and he raised interest rates. I mean, interest rates were up to almost 20% in the 80s.
Yeah.
And that's when we were finally able to get out of, that neck of the woods. I mean, it was policy change after policy change. Jeremy Siegel actually said that, that the 60s and 70s were marred by just horrible policy making of, just tacking on dollars. It started with Nixon.
Actually started with Johnson. And the Great Society. Vietnam was also there. Huge amounts of money spent on Vietnam through the Kennedy years, through the Johnson years, through even into the Nixon years. And then you had the Great Society. And there were positive things that came from that. You had Medicare that came at the same time. You had
Medicaid,
civil
too.
rights at the same time. All of that grouped together. But it also
There was
meant
a cost.
And
There's no free lunch, right?
no free lunch. And when you had Arthur Burns as chairman of the Federal Reserve in 1972, he wanted to lower interest rates rather than raise interest rates.
Why? Because of an election year.
Election.
Yep.
Yeah. I think one of the lessons you draw from that is today, in those days, you didn't have index funds. Today, you have a huge number of people that think by putting their money into an index fund, they'll do as well as the market. But history doesn't repeat, but it rhymes.
Yeah.
And what we saw in the 60s and 70s is the market didn't keep up with inflation. If you look at the Standard & Poor's in 1961 and the inflation numbers in 1961, between 1961 and 1993, inflation grew sixfold. From 1961 until 93, it took until 93 for the Standard & Poor's to catch up with what inflation was. It's not a quick fix. And that's the issue with index funds.
And if they were around then, they would have rose up and down, and kind of like what we're seeing today. It's like one week we're up 5%, the next we're down 10%, the next we're up, and then we're down, and there's a lot of similarities. And so, I have a lot of people asking me, what do you do right now? What the heck do you do with your money if you can't just index it anymore, right? The last 10 years you've been able to do that and be pretty successful. Rising tide lifts all boats, right? But now we're getting into this period of time where you have companies with too much inventory, they're laying people off, yet there are some silver linings in the economy. And I think we saw the exact same thing in the 70s with the Nifty 50.
Yes. You looked at that.
I did, yeah. And so it's really interesting. Through this time, it was grim. Being in the market, it was up and down. Interest rates were rising, inflation was high, but there were 50 companies, there's probably a few more, but we call them the Nifty 50, that were the cream that rose to the top and were able to ride out these tough times.
We're going to talk about the names that made it through the 60s and 70s, why they made it through the 60s and 70s, and does that give us some idea of where we should be in the 2020s, 30s, and 40s. So you started to mention the Nifty 50.
The Nifty 50, yeah, and just retrace where we were, between 61 and 79, cash lost 70% of its purchasing power. The market was up 20%, down 40%, up 20%, down 50. I mean, it was a roller coaster of a ride. But through that time, there was a silver lining. There were companies that did really well. And these are companies that are still around today and are, quite frankly, are the blue chips of today. These are the McDonald's of the world. These are the J.C. Penney's, the Johnson & Johnson's. What's another? Sears, Walmart, Walt Disney, Anheuser-Busch, American Express. All these companies, I like to say, rose up through the ashes like the phoenix, right? And during these tough times, during these periods where a lot of companies were going out of business, where the Dow was going up and down, they were able to ride the wave, and they're still around today.
They are. But at that time, think about it. Bristol-Myers, Merck, Pfizer, those were companies that were part of the Nifty 50. That was the pharmaceutical industry. Today we think about the pharmaceutical industry. It's huge. We talk about drug prices. But it wasn't until World War II that Pfizer was able to commercialize the production of penicillin that the pharmaceutical industry was born. It was born then. Those pharmacy companies were new companies. They were new technology at the time. You didn't mention IBM, but remember, IBM built computers during World War II. Before that, they were a business machine company building cash registers and whatever. They became computers, and the computer industry was new and nascent. It was just beginning to grow. McDonald's came public in 1966. The Dow's at 1,000. McDonald's is brand new, and they've got the big signs showing how many hamburgers have been ordered.
Heck of a time to go public.
And yet, over that period of time, their stocks soared. I remember in 1972, I bought my first stock. It was a company, the call symbols were AMDV. The stock was down 70% or 80% from where it had been. Reminds me of some of the stocks of today. Brand new stock. They were making random access memory, RAM. I didn't really understand all that was, but as I learned a little bit about it, I bought the stock at 10. It had been in the mid-30s or maybe $40 a share before. The stock went from 10 in 6 months to 30. I sold. I learned my first lesson, maybe a couple lessons I learned looking at new technology and new things that were happening as the market had tumbled down. That recovered very quickly. And I sold. For years and years, I thought I had a triple. That old saying that bulls make money, bears make money, pigs get slaughtered. I was thinking I didn't want to be piggish about this whole thing. The lesson I learned is that stock went on. Had I held those shares and sold at the very peak, which I wouldn't have, but had I sold at the peak, those shares would have gone from $10 to $1,756.
Nice profit.
That was Advanced Micro Devices. It was, way back then, it was making RAM. But that's happening today. Those are the stocks that are going to go forward as we look to the future. They're stocks that have pricing power. They have cost under control, and they're creating a lot of cash.
And do they have, what's their debt load, the other thing?
No debt load.
No debt load.
Well, there you go. Squeaky
That's
clean
the thing.
balance sheet.
So if interest rates go up, so what? They're creating enough from their earnings, they don't have to borrow money. If you look at some of the old companies that are today financing debt at 2 and 3% when it comes due, and interest rates are at 6 and 7 and 10%, what does that do to their bottom line? These are companies that had no debt. They were simply growing from throwing off cash. And they were throwing off so much cash that they were building the cash on the balance sheet at the same time. Their sales were growing 2 and 3 and 4-fold, 10-fold. And there were a lot of companies like that. Polaroid. I can't remember the stocks and how many times they grew, but a lot of stocks grew not 10 times over, but 70 or 80 or 90 times over. Just having one of those stocks in your portfolio. one of those stocks would have been huge. An IBM, a McDonald's, a Polaroid, a Bristol Myers, a Merck. Those stocks were all creating a huge amount of value, and they didn't need to borrow money. They were unaffected by what was going on in the interest rate market. Whereas you look at General Motors, for example, General Motors had a lot of financing going on and had to borrow money. And so as interest rates went up, that affected them. The home builders, the banks, the standard things which today would be in index funds were struggling because their cost of borrowing was increasing every 6 months, every year. The new companies, they didn't need to borrow. And that's where we need to be as we go forward. And yeah, we've seen things drop on some of these new companies, 40 and 50 and 70%. But I remember Advanced Micro Devices. And even though I was stupid in selling at a triple in 6 months, when I got into the business, actually, I had a stockbroker at the time. And when I was going to get into this business, I talked to him about going to work for the firm he was working with. And he said, I bought the stock in 72. So it's 86, 14 years later. And he said to me, what was the name of that stock you bought? So, Advanced Micro Devices. Oh, yeah.
Do you think we'll see a lot of mergers in these small companies that are struggling? That will be some sort of consolidation, or they get bought, gobbled up by the Apples and the Microsofts, right?
They do get bought by the big companies.
Yeah.
But I'm not sure that we saw a lot of that go on then. We saw a decent amount happening.
You know, and if cash is king, wouldn't you just wait for those smaller companies to go out of business and take the market share?
If you can get a small company to go out of business, but for the small companies that are really growing, number one, they didn't want to be purchased by anybody. But it gave way in the 1980s to greenmail and to the people who came in and wanted to take companies private because they were in such bad shape. So that's where we're going. I think that's the lesson of today is as inflation comes about, there's a time to be involved. And it's being at the right place at the right time. And it will be a stock picker's market.
Mm-hmm. And I think this is a great time for us. You know, I mean, this is what we do, right? And we're talking to a lot of our clients and people that we trying to make clients and telling them that this is the time to when you want to get in, as opposed to wanting to sit in the sidelines and cash and buy index funds. I'm not saying don't hold some cash, but you're not going to beat inflation by holding cash.
That's
and you're
true.
not going to beat inflation by holding CDs. And, you know, the question I ask people is, what are you going to think 3 or 4 years from now when you look back and say, dang it, I should have put a little portion there, right? Because now I'm at the same place I was in 2000,